let's cut through the noise. We're not here today to talk about the day-to-day chatter of the market. We're here to talk about a signal that's getting so loud it's becoming impossible to ignore. We're going to look at silver, but not as a trade. Think of it as a critical piece of intelligence, a memo on the structural health of our entire financial system. And the data? Well, it suggests we're at a profound inflection point. Our job is to figure out what that means for long-term wealth preservation. So let's begin. $30. This number, this is at the very heart of our conversation today. Now, this isn't a price target. It's not some milestone we've passed. It represents something much, much more important. A fracture. A crack in the system. It's the premium, roughly, that people are willing to pay to get their hands on physical silver right now versus the price you see on a screen. That disconnect, you see, between a promise and a possession, that's where the really big market shifts always begin. So what happens when a market can't actually deliver the thing it's selling at the price it's quoting? Well, that price becomes a work of fiction, doesn't it? And this isn't some small problem for a few traders. No, this is a systemic warning light flashing on the dashboard. It's telling us there's a fundamental loss of trust in the whole paper contract system, the very architecture of modern finance. And the real cost? It's the erosion of confidence. And you know, confidence is the one asset you can't just print more of. Okay, here's the problem in black and white. A paper contract, a promise, might tell you silver is $90. But if you want the real thing in your hand, you're looking at something closer to $120. That $30 gap, that's the silent truth of this market. It's telling you that the people who want actual possession are willing to completely ignore the paper price. This, right here, is price discovery starting its long journey from financial fantasy back to physical reality. But look, this isn't really a story about one commodity. It's much bigger than that. It's about the immense, incredible pressures building up inside the global system. Silver's recent behavior, it's just a symptom. It's like a highly sensitive instrument picking up the first tremors of a massive earthquake. An earthquake in the world of debt and currency. To really understand silver, you have to first understand the shaky ground it's standing on. It really boils down to two massive, inescapable forces that are pushing on the foundations of the system. And these aren't your typical cyclical trends, the usual ups and downs. No, these are generational, structural shifts. And their convergence is creating an environment unlike anything we've really seen in modern times. Let's take a look at each one. The first force is what I call the global debt supercycle. This isn't the 1980s. We have hit a wall. We're at the mathematical and, I think, the psychological limit of how much debt the world can handle. Every major economy is drowning in it. This creates a desperate, systemic need for an escape hatch, an alternative to fiat currencies that are backed by the very debt that's now threatening to collapse the system. The pressure is just immense, and you see capital scrambling to find anything outside of that system. And the second force, it's the simple fact that our money is being debased, and the official inflation numbers, well, they just aren't telling the whole story anymore. The market knows this. It's a truth-telling machine at the end of the day. It sees the real cost of energy, of food, of housing, and it's positioning for what comes next. See, smart capital isn't reacting to last month's CPI report. It's positioning for the decade of inflation that's needed to deal with all that debt. And silver? Well, it's the canary in that coal mine. And you can see the market's urgency right here. The gold-to-silver ratio, which has always been a great measure of fear in this system, is compressing fast. As it drops from 80 down towards 40, it signals a major shift. We're moving from just passively hedging against a crisis to actively hunting for deep, tangible value. Silver outperforming gold like this is a classic, textbook sign that we're hitting an acceleration phase of this cycle. So that brings us to our first major strategic pillar. The center of gravity for physical metal is shifting. For decades, generations really, the price was set by paper trading in New York and London. Well, that era is coming to a close. The price is now being set by those who demand the actual physical metal. And that demand is centered in the East. And here's the proof, right in the numbers. While New York is quoting $90, Shanghai is consistently paying a premium, closer to $100. This isn't just a temporary glitch. It's a powerful economic magnet. It is literally sucking the world's very limited supply of deliverable silver out of Western vaults and rerouting it to the East. This arbitrage, this is the engine that's driving the physical drain. The implication here is profound. The ability of Western paper markets to keep a lid on the price has always depended on one thing: their ability to deliver the metal if called upon. But as their stockpiles are drained by that higher Eastern bid, their power vanishes, day by day. The paper tail can no longer wag the physical dog. The West is losing control of the price, and for the first time in generations, it's becoming a price taker. So the strategic takeaway from this massive geopolitical shift is clear. The value of what you own is no longer just a number on a screen. It's increasingly about jurisdiction and your actual physical access to the asset. A bar of silver in a vault in Shanghai now has a structurally different value than a paper claim in New York. Proximity, where your asset is becoming everything. Now for the second pillar, and this one has absolutely nothing to do with monetary concerns. It's silver's role as an essential, indispensable industrial commodity. This creates a bedrock of demand that just won't go away, and it acts as a powerful floor under the price. This demand isn't optional for these industries, it's imperative. And this demand is so powerful because it's what economists call inelastic. A huge and growing chunk of the world's silver supply gets completely consumed, it's gone forever, by industries at the heart of these global megatrends. I'm talking about the green energy transition, electrification. These aren't reversible policies, they're mandated, which means their demand for silver is almost totally insensitive to price. They have to have it. And this is where things get really interesting. You have this strategic tension. As demand from investors rises, people who want silver as money, it starts competing head-to-head with this inelastic industrial demand. So you've got factories that need silver for solar panels fighting against sovereign wealth funds who need it to preserve capital. It creates this feedback loop where investor hoarding starves industry, which then forces those industrial buyers to bid the price even higher to get what they need. The logical conclusion here is that silver becomes a strategic national asset. To protect their multi-trillion-dollar green energy plans, governments could start classifying silver as critical and begin stockpiling it. At the same time, corporations will be forced to just bypass the exchanges entirely and go buy the mines themselves to secure their supply chains. Both of those actions would pull massive amounts of supply off the market, putting a very, very hard floor under the price. Okay, our final pillar is psychological. For decades, the price of silver was contained not just by paper contracts, but by the market's belief that those contracts worked, that the system was sound. Well, that belief is now collapsing. What we're witnessing is a massive realignment in market psychology. It's a return to first principles about what money really is. What we're really seeing is the end of a 40-year regime, an era dominated by paper derivatives. The breakout we've seen above key levels like $90 isn't just a technical blip on a chart. It's the symbolic end of that era. The market is signaling a huge structural shift away from a system of promises and back toward a system based on physical settlement. The failure to hold the price below that $90 level was a massive psychological event. It proved to the entire market that the resources of the price managers, while huge, are not infinite. It proved that determined, global, physical demand can, in fact, overwhelm any paper scheme. And that loss of perceived control is a huge catalyst. When the market stops believing that the game is rigged against them, the whole game changes. And this loss of fear kicks off a very predictable cascade of collapsing confidence. First, holders of paper accounts start asking, hey, wait a minute, is my metal actually there? They demand delivery. That starts a run on the vaults, which exposes just how little physical metal was backing all those paper claims. And then comes the final irony. The very institutions that once benefited from holding the price down will be forced to quietly become buyers themselves. Now, in the coming weeks and months, you are going to hear the mainstream media use this term over and over again to explain what's happening. A short squeeze. It's a convenient, simple story. It lets them put this whole event into a familiar little box. They'll talk about hedge funds and technicals because, well, that's a story they know how to tell. But we have to understand, this is a profound misdiagnosis. The short squeeze is merely the spark. It's the match that lights the fire. It is a symptom of a deeply, deeply broken market, not the actual cause of the repricing. Focusing on the squeeze is like analyzing the matchstick while completely ignoring the fact that the entire forest floor is soaked in gasoline. The real event, the real story, is this: a forced global repricing of physical reality over financial abstraction. The squeeze is just the mechanism. It's the violent, sudden way that decades of currency debasement, supply deficits, and a broken paper market are finally being reconciled. It's the financial system being forced, kicking and screaming, to finally acknowledge the laws of physics. So, after all that, what is the core strategic takeaway from all these converging forces? When the noise gets deafening, how do we distill the one true signal? It really comes down to a single, simple mandate for anyone who's trying to navigate the very tricky decade ahead. The mandate is actually very clear. We are leaving an era that was defined by counterparty risk, by layers and layers of financial promises. The number one directive for preserving your wealth, then, is to reduce that complexity. It's to hold assets that are simple, that are proven, and that are final. Assets that don't require someone else's promise to have value. And let's be absolutely clear about the ultimate outcome here. What's unfolding is not just a simple transfer of wealth from one group to another, it's far more fundamental. It is a transfer of power. Power is shifting away from those who can create currency out of thin air and to those who hold real, finite, tangible assets. This isn't about getting rich in dollar terms. It's about securing your own sovereignty in an increasingly uncertain world. Now, before we finish up, it's important to remember that the financial landscape is in a constant state of flux, and it's absolutely crucial to approach it with diligence and a clear-eyed view of your own personal situation. The insights shared in this explainer are for educational and informational purposes only. They do not constitute financial, investment, or legal advice. Every investor's situation is unique, and you should always consult with a certified professional before making any significant financial decisions. Our goal is to help you find the signal, but the final move is always yours. Stay sovereign, stay informed.